Tom bought a house. Jerry rented the house next door. Everyone told Tom he was winning. Jerry was throwing money away. Tom was building equity. Jerry was paying someone else's mortgage. The neighborhood had already decided who was smarter. Then the roof started leaking. Tom discovered something strange. The house belonged to him. So did the roof, the plumbing, the property tax bill, the insurance bill, and every surprise hiding behind the walls. Jerry called the landlord. Tom called a contractor. That was the moment the neighborhood stopped looking so simple. Today we are following two neighbors for 30 years. One buys, one rents, and we are going to track every dollar. Stay to the end because the person who throws money away may be the one quietly building the larger fortune. Imagine two houses sitting side by side. They look almost identical. Same street. Similar size. Same neighborhood. Tom walks into one. Jerry walks into the other. Tom says he wants to buy. Jerry says he wants to rent. The neighbors immediately choose sides. Tom gets congratulated. Jerry gets financial advice. Nobody asks to see the spreadsheet. That is the problem. Because buying a house is not automatically an investment. Renting is not automatically throwing money away. The answer depends on what happens to the money between the front door and the future. Tom finds a house priced at $300,000. He puts money down. Then he borrows the rest. The bank gives him a mortgage. Tom gets the keys. He feels like he owns the house. Technically, he does. But the bank also owns a very large piece of the financial story. Tom now has a mortgage payment. Part of that payment reduces what he owes. Part pays interest. The house sits quietly while the money moves every month. Jerry rents a similar house. His rent payment does not create home equity. That part is true. But Jerry has a different advantage. He needs less money upfront. He does not need to finance the entire purchase price. He does not need to replace the roof. He does not need to repair the furnace. And he does not need to worry about every cracked pipe. The neighbors hear this and laugh. Rent is throwing money away. Tom smiles. Jerry keeps renting. The story seems finished. It is not. Because Tom's house has a roof. The roof does not care about Tom's mortgage. One rainy Tuesday, water appears on the ceiling. Tom calls a roofer. The roofer gives him a number. Tom discovers that the roof has no sympathy for homeowners. Jerry looks through his window. His ceiling is dry. He goes back to watching television. Tom pays the repair bill. This is the first cost that rarely appears in the buying versus renting argument. Ownership has maintenance. A house is not a savings account with bedrooms. It is a machine. It has pipes, wires, appliances, windows, walls, a furnace, a roof. Machines break. Tom pays. Jerry keeps his money. Then property taxes arrive. Tom pays again. Homeowners insurance arrives. Tom pays again. Jerry pays renters insurance. Usually much less. The neighborhood still says Tom is winning. But the spreadsheet is getting longer. Now Tom makes his mortgage payment. Jerry makes his rent payment. Tom is building equity. Jerry is building nothing inside the house. That sounds like a decisive victory. But there is another question. What is Jerry doing with the difference? Suppose Tom's total monthly housing cost is higher than Jerry's rent. Jerry has extra money. He could spend it. If he does, the homeowner may eventually come out ahead. But suppose Jerry invests the difference instead. Now the story changes. The renter is not simply paying rent. The renter is also buying financial assets with the money that did not go into the house. The house is an asset. The investment account is an asset. Now the neighbors have a problem. They can no longer compare rent with a mortgage payment. They have to compare entire financial lives. This is where the math gets uncomfortable. Tom has a house. Jerry has investments. Tom has a mortgage. Jerry has rent. Tom has repairs. Jerry has a landlord. Tom has property taxes. Jerry has fewer direct ownership costs. Tom has home equity. Jerry has liquid investments. 2 neighbors. 2 balance sheets. Now the house begins to appreciate. Tom feels vindicated. The property rises in value. His equity grows. The neighbors congratulate him again. But Tom has to remember something. He does not get to spend the appreciation while living in the house. The value is trapped inside the walls. To access it, he may need to sell, or borrow against it, or wait. Jerry's investments may be easier to sell. He can move. He can rebalance. He can access cash. Tom has a front door. Jerry has flexibility. Neither is automatically better. They are different assets. Now imagine the mortgage. Tom borrowed $270,000. The house cost $300,000. Over decades, Tom makes payments. The total amount paid to the lender can be much larger than the original loan. Interest is the price of borrowing. The longer the loan lasts, the longer the lender collects interest. Tom is not just buying a house. He is buying it with time. And time is expensive. Now imagine Jerry's rent. Rent increases over the years. That is a real risk. Jerry cannot assume today's rent will last forever. The landlord can raise the price. The neighborhood can become more expensive. Jerry may eventually pay more. So renting has its own uncertainty. The difference is that Jerry can move. Tom owns the address. Jerry owns the ability to leave it. Then Tom's property tax bill increases. The house became more valuable. The tax bill follows. Tom is richer on paper. The government also knows it. Tom's insurance premium rises. The roof gets older. The plumbing gets older. The furnace gets older. The house is appreciating. The house is also aging. Both things can happen simultaneously. Now the neighborhood reaches year 10. Tom has made 10 years of mortgage payments. Jerry has made 10 years of rent payments. Everyone asks the same question. Who won? Nobody can answer yet. Because we still have to count the money nobody sees. Tom paid interest. Tom paid taxes. Tom paid insurance. Tom repaired the roof. Tom replaced appliances. Tom spent money maintaining the house. Jerry paid rent. Jerry paid renter's insurance. Jerry invested the money he did not spend buying the house. Now the calculation gets real. The purchase price is only one line. The rent is only one line. The difference between winning and losing can hide in the other lines. Now convert the numbers into ordinary life. Suppose Jerry saves and invests $500 every month compared with Tom's higher housing costs. $500 sounds small. It is the cost of a few restaurant meals, a phone bill, a grocery trip. But $500 invested every month for 30 years becomes a very different number. The money has time to grow. This is where compounding enters the story. Jerry is not just saving $500. He is giving every previous dollar a chance to produce more dollars. Time becomes another employee. Tom has one too. His house may appreciate. The difference is that Jerry's investment can grow without requiring a roof. Now imagine 30 years passing. Tom finally pays off the mortgage. The house is his. Completely. The neighbors cheer. Tom has reached the finish line. Jerry is still paying rent. That sounds like the end. But now we ask one final question. What is the house worth? And what is Jerry's investment account worth? The answer depends on decades of variables. Home appreciation, rent increases, mortgage interest, maintenance, taxes, insurance, investment returns, buying costs, selling costs, the length of time each person stayed, the location, the timing. There is no universal winner, but there is a universal mistake. Comparing rent to a mortgage payment. That is like comparing a hamburger to a restaurant's entire electricity bill. The numbers are real. They just do not describe the same thing. Now imagine Tom sells the house. The house is worth $600,000. Tom feels rich. Then the selling costs arrive. Real estate commissions may apply. Closing costs may apply. Moving costs appear. The $600,000 number is not necessarily the amount Tom puts in his pocket. The house has a price. The transaction has a cost. Jerry sells some investments. His transaction may look very different. The money can be more liquid. The account can be divided. He does not have to sell the entire house to access part of his wealth. That flexibility has value. Now the dark part. Tom's house may have made him wealthy. Jerry's investments may have made him wealthy. But the person who blindly followed the neighborhood's advice could lose. A person can buy too much house. A person can rent forever without investing the difference. A person can buy in the wrong location. A person can move every few years and repeatedly pay transaction costs. A person can rent cheaply and invest consistently. A person can buy a modest home and stay for decades. The decision is not house versus rent. The decision is what you do with the money. Now return to the two neighbors. Tom owns the walls. Jerry owns the portfolio. Tom gets a roof. Jerry gets flexibility. Tom builds equity. Jerry builds liquidity. Tom pays repairs. Jerry pays rent. Tom borrows money. Jerry invests the difference. Both are making financial decisions every month. The only difference is where the money goes. That is the part nobody puts on the real estate sign. Buying a house can be brilliant. Can also be expensive. Renting can be wasteful. It can also be financially efficient. The answer is not hiding inside the word rent. It is hiding inside the entire 30-year journey. The house is not free just because you own it. The rent is not wasted just because you do not. Tom's neighbors wanted a simple winner. The spreadsheet refused to give them one. Because the person who buys the house gets an asset. The person who rents gets an opportunity. An opportunity to invest the difference. An opportunity to stay mobile. An opportunity to avoid a roof that leaks at 2 in the morning. The question is whether they use it. So when someone says, rent is throwing money away, ask one question. Compared with what? Because sometimes the most expensive house is the one you buy simply because everyone told you that you should. And sometimes the cheapest house is the one you never bought. The math decides, not the neighborhood.